Hello everyone, welcome back to our channel Options Trading Made Easier. We are starting a new series on stock market covering all the concepts from basic to advanced, all the terminologies which can be understood by even a person with no knowledge of stock market. I guarantee you, after watching the complete series, you will be having enough knowledge on how to invest and earn a good amount of returns from the stock market. Let's get started with the video. Firstly, we have to understand what is the difference between share market and stock market. Share market is a market where the trading of shares of a particular company takes place. That is, buying and selling of shares of a particular company takes place in share market. Whereas in stock market, there are various financial securities such as bonds, derivatives, and forex trading takes place. So, if you consider stock market as a bigger umbrella, then the buying and selling of shares, bonds, and derivatives that falls under. For example, when you go to a mall which consists of different stores, that store individual is called as a share market, which focus on only one type of product, whereas the mall itself, the bigger place, is called as a stock market. Now, stock market, exchange and indexes. What does the stock market do? The stock market facilitates the process of buying and selling of shares of different companies. Stock exchange. The stock exchange acts as an intermediary that connects buyers with sellers. For example, consider a person buys a stock of a particular company at rupees 50, and now the price of the share has increased to 70 rupees. Now he wanted to book the profit. But another person who sees the stock at the price of 70 and he feels that it's a good price for buying considering the fundamentals of the company. So the one person that sells will be brought by the other person. This type of exchange of stocks between two persons takes place through buying and selling with the help of intermediary, that is the stock exchange. There are 23 stock exchanges in India, of which there are only two national level stock exchanges. These are National Stock Exchange, that is NSE, and Bombay Stock Exchange, that is PSE. There are remaining 21 stock exchanges that are limited to certain areas. These are called regional stock exchanges. Now, next is stock index. An index is derived by considering a group of stocks, and it is given a numerical value, and that index moves in accordance with the collective performance of the stocks listed in the index. For example, there is an IT index which consists of all the information technology stocks, and if the information technology stocks perform better, then the index moves in a positive way, and vice versa. Next is, why do companies list in the stock market? So the company gets listed through IPOs, that is initial public offerings. The companies get listed because the primary goal of a company to get listed in the stock market is to raise funds. That is, when a company is listed in the stock market, the share gets brought by the investors, which in turn the company's fund get increased, which can be used by the company to extend their business and to increase the standard of their business. Next is credibility. Credibility means visible to a longer extent of people. By listing in the stock market, the company gains credibility with potential customers, retailers, and investors. That means when the investors invest in a particular share, that will attract new investors and customers, and the business gets extended through it. Next is liquidity. Liquidity means the higher volume of buying and selling of shares in the stock market. That means the volume at which the shares are bought or the volume at which the shares are sold. That is called as liquidity. Now, understanding of the stock market. The company which want to raise the capital, it will get listed in the stock market through initial public offering, that is called IPO. That means if a company want to expand or fund new ventures, can raise its capital by selling its shares of ownership to the public. These shares also called stocks. Investors buy these shares by investing in the company. Thus, the company selling the shares to the public is called an initial public offering. Next is buying and selling of shares. Investors buy the shares of a company in the stock market. The price of a share fluctuates based on the market sentiments and the company fundamentals and the profits earned by the company during the quarter. If a person invested at a lower level of a stock, then when the company performs well, he will be earning a certain amount of money, which is called as capital gain. If a money is earned through investing, it is called long-term capital gain. And if it is earned through trading, it is called short-term capital gain. The company also distribute a portion of profits to the shareholders through dividends, which will be around 0.5% of a share value. Next, it's important concept, trading versus investing. So, investing involves buying and buying of shares and holding for a long term. The fundamentals of a stock is analyzed before buying it. That is the fundamentals such as price to earnings ratio and the profit it made throughout the quarter. Considering the trading, investing is less riskier and gives a good returns in long run if the fundamentals of the company is good. Next, trading. Trading involves buying and selling of shares over a small period of time. That means if you are buying today and if you are selling it today itself, it's called intraday trading. And if you buy today and if you sell within a week or something, that is called positional trading. In trading, we basically consider more on technical analysis rather than fundamental analysis. The technical analysis involves chart patterns and market trends. Since we do trading in within a week or within a day, it is more riskier. And if it is managed properly with good risk to reward ratio, profits can be made in a short period of time. Now, regulatory bodies of stock market. That means the stock market is controlled by Security Exchange Board of India, that is SEBI. SEBI formulates rules and regulations governing to various aspects of stock market. That is, if a company wants to get listed in the stock market, uh, what are the conditions it needs to fulfill, like that. And it also based on the investor protection, like if a person who does not know anything about stock market and if he comes to invest or trade or something, it will give some guidelines regarding the investor protection. Next, consider this. You are here, group of people. You consider some of the stock brokers to open your Demat account. You open the trading account and you buy some of the shares. It will get stored in the Demat account. and you do trading through NSE and BSE by transferring funds from bank to the trading account. These are the steps involved in opening of a Demat account. Firstly, verifying your personal details and completing the KYC process and digitally signing the documents. If you want a detailed video on how to open a Demat account, then you can comment below this video. I will try to make a video on opening of the Demat account. You can open the Demat account through the link given below in the description. If you find this video useful, please like, share with your friends, and comment below and subscribe to our YouTube channel. Thank you so much for watching.